On stage, Amit Chandra, partner and chair of Bain Capital India, driving one of the largest private equity platforms in the country with marquee investments across sectors. Manish Kejriwal, founder and managing partner of Kedaara Capital, known for backing high-quality businesses and building one of India's leading homegrown private equity firms. Kunal Shroff, managing partner at ChrysCapital, shaping one of India's most successful private equity firms with a strong track record of value creation. And moderating this session, we have Achintya Mangla, Citi's head of financing, investment banking, leading strategic financial solutions and capital market executions for clients. Loud round of applause for our panelists, please.
Asking for global investments and private capital, I think it's the perfect session now to have three stalwarts of Indian private equity with us. We have Amit Chandra, chair of Bain India, Kunal Shroff, managing partner of ChrysCapital, and of course Manish Kejriwal, founder of Kedaara Capital. Gentlemen, thank you for being with us today.
Pleasure.
A few quick rapid-fire questions to begin with and break the ice, and then we'll delve into a few more questions. One word that is overused in the Indian PE pitch deck. Amit, with you.
AI.
He picked my word, but not in the pitch deck, but at least in conversations, FX.
FX.
You picked both my words. We finally know what DPI means.
Finally. Okay, that's good. I'll start with you this time, Manish. One asset that you wish you had bought, but these two bought, or someone else bought?
I think the one we really missed was Nika. Having said that, we got the consolation prize in purple.
Okay.
And I'll say it softly for all the people in this room. When that goes public, it'll really beat the living daylights out of the other one. And
Citi will lead it?
Absolutely.
Thank you. There you go.
For me, I think I'm spoiled for choice. I have to just look at his portfolio, and there's so many there. But I would pick Vishal Megamart. It's a $6 billion market cap company. They've done extremely well there. Wish we had done that.
Amit?
The asset we would have loved to buy, which nobody bought, was actually Zerodha. We were behind Daytech, which led to the creation of Ameritrade. So we understood that space.
Yeah.
And I come from the world of banking and trading. So we should have actually seen something like that happen.
Nice. Good mix. Over or under $5 billion dedicated India fund? Kunal, with you first.
What time frame?
3 years.
Unfortunately, I'll say under.
Under.
Just to clarify, I think it will get there. But
what time frame? 5 or 10?
10 years.
10 years.
10 years.
I'll say it's already happened.
Yeah.
Because if you look at the last Bain Capital Fund and now the Blackstone Fund, I'd say 50% of the capital will go to India.
Go to India.
At least, for Blackstone at least. That's a $13 billion, that's a $7 billion fund already.
Yeah.
If you look amongst the Indian GPs, I'm sure Kunal will be the first one cracking $5 billion.
So we'll go, and he's underselling. Amit, I guess that's the answer.
I'll take the over on that.
Yeah.
I'm an investor in 15 Indian funds, and I think the time is now. We actually need to move the mix of private capital deployed between foreign and domestic sources to more like 50-50 from about 80-20 at this point of time.
Yeah.
And so I would take the over on that.
Yeah, excellent. That's a good mix again, but I think overall bullish. We will dwell into it a little bit more, and I know every panel has talked about AI, but in one word, is AI an advantage, a tailwind, or a headwind for India?
I think AI would be a headwind for the macro.
Yeah.
But I think it's a tailwind it could be a tailwind for most of us if we're early adopters for the portfolio.
Yeah. Kunal, say.
I would agree.
I agree with both with Manish. Yeah.
But I guess the question is, if it's a headwind for the macro, ultimately it'll become a headwind for all of the portfolio companies as well.
I think the only thing I'll say is it's still unclear.
Yeah.
what the ROI is and where it goes. So currently it looks like a headwind, but we'll see how it plays out.
Yeah, no, it's interesting because it'll democratize how work is done by a lot of companies. And so essentially, if you analyze how India has grown in the last 25, 30 years, a lot of that growth has been taken away by very large corporations.
Yes.
And I think AI could actually provide an opportunity to the smaller and mid-sized companies.
Yeah.
And the reason I would fundamentally disagree with you on this one is if you really get back to this panel, what is the value we bring if we can't differentiate the performance of our private which is, and if we aren't in the top quartile or the top decile performance for our portfolio vis-a-vis the rest of the industry. And I'll give you the conjoint was COVID, right? I mean, COVID was a disaster for both mid-scale companies. But I'd say all three of our portfolios, because we had unlimited access to capital, but more importantly, the right talent.
Correct.
Even though our revenue and EBITDA numbers fell absolutely, market share we gained. So coming out of COVID, we were a lot stronger. And I would imagine the same thinking could apply to AI
100%.
if we didn't fool ourselves and actually work with the portfolios.
And I think that's the value creation aspect that all of you are talking about and all the private equities are talking about. But again, we won't dwell too much into it, but I must admit the perception right now globally seems to be that it's more of a headwind for India Inc. overall than a tailwind compared to some of the other countries, but we'll address it. But going back to, India, and we've been all bullish about it, and you've just raised a 10 billion fund, which a large part of it is India. 25 was a difficult fundraising year globally in private equity. Hardly any exits, hardly any IPOs, a lot of continuation funds. India was the right differentiator, right? Both in terms of IPOs as well as fundraising. And Amit, given you have raised the 10 billion with 20% at least in India, how much of that is a secular, differentiated, India-driven aspect versus a relative measure between, China is not the flavor of the month, so we're going to allocate to India, and the risk that now that Japan is coming back, we lose some of it?
Yeah. No, folks like us always take a more sanguine view than what market investors take, which is the here and now view.
Yeah.
So you'll always hear this kind of, Japan's coming back and, China's out of flavor, and maybe at this point in time, a lot of people feel that India's out of flavor. I don't think private equity really works that way. Typically, we have a 3 to 5 year deployment cycle when we raise our money, and we are bottoms up asset pickers. We can easily sit on our hands, for a year or 2 years in a particular market, and often you'll find in the same market which may be quote unquote out of flavor, you'll find sectors which are really interesting and people who want to do deals. And so for us, really, this whole kind of top down notion that market investors need to make is not really something that we need to worry about. In fact, often it's something that we can use to our advantage, and we do.
Yeah.
Sometimes the best deals you get is basically because the market is actually thinking that way.
Yeah. Kunal or Manish?
Yeah, sure. So I think the joke is when ChrysCapital was raising their 10th fund, the line was flat is the new up, and that's what globally people were seeing, if not down.
Yeah.
And I think India is in a very different spot.
Yeah.
There's so much growth and so many building blocks of the ecosystem are in place that we think the next decade can be extremely attractive for private equity. Doesn't look like that. It doesn't look like that given all the headwinds right now. And I think from a global lens, India has actually suffered. It's not that China capital has come to India, because I think there's been a strong home bias. And because the large pools of capital are in the West, they've retreated back to the US.
Yes.
Or they've said, look, a country fund experiment in China hasn't really played out.
Correct.
So should we double down on India or not? And I think that's been a bit of a pause.
Yeah.
So the success that Asia funds have had is because global LPs feel a little more comfortable that they're not taking a bet on one country.
Yeah.
And my hope is, in the future, India country funds also rise to the occasion.
And Manish?
I'll do it comprehensively. I think for the region, the only place where there was a reallocation, I agree completely with Kunal and with Amit, was not with LPs reallocating from China to India, but it's the half-pregnant global funds who had regional funds.
Yes.
When they raised their last fund, they had no choice. Historically, they were doing 50% or more in China. And that, but it wasn't only India, it was also Japan and Australia, right? So that was one. India, as sanguine as Kunal, while the macro is good, the terrific headwinds, I think it really boils down to performance.
Yeah.
So I think this will be a winners-take-all model where LPs will consolidate the number of GP relationships they have. And there'll be a few players raising money relatively easily. And I think for others, it'll be game over or it'll be a real stretch. And Japan, your final question to me, there was already a Japan pivot. Like that's where, if you look at Japan as a macro, they pivoted away from China into India for very geopolitical reasons. So actually, at least as far as we're concerned, I'm sure Kunal also, we've been a net recipient of a lot more Japanese capital.
Makes sense,
which has come here. So it really hasn't, if there has been a portfolio allocation, Achintya, it's such a high level. We don't see, we're little red dots, in the middle of nowhere. So we don't get to see that the capital swinging at a macro level. We just see what's coming to us. And I'll just say the level of Japanese capital which is coming, it's very difficult to get it, but once you get it, it's almost like permanent capital.
And I think this is an important trend because the sentiment or the time frame of investing, Amit, as you said, for private capital is very different from public capital. And right now, I think a lot of us are seeing it. The FII inflow into public equities has taken a backseat, at least for the last few months. Arguably, as the private company formation grows, private capital is going to continue to play an even more important role. And maybe that, Kunal, I'll ask you, right? You all started the private equity business in India maybe 15 years ago, 20 years ago. How much of that so far has been multiple expansion, structural GDP growth in India versus real value creation? And do you see that mix changing in the next 10 years? And that's probably related to having minority investments versus more control investments. So maybe, Kunal, I'll ask you to take that first.
Sure, this may take a while. So I think India has matured a lot. When ChrysCapital got started 27 years ago, the first 10 years, I would say, was largely growth-driven. The pitch would be pick the right sectors, partner with the right management team, be supportive. Growth will be 80% of your returns, right? The last 10 years hasn't been that, and the next 10 years, you're going to see even more value creation. But I think the bigger nuance is if you compare to global returns. I don't know if folks have seen the Bain and McKinsey reports on private equity. Bain has a line saying 12 is the new 5. And what they mean is to deliver the 20+% net returns, GPs will have to deliver 12% EBITDA growth, which used to be 5% earlier. My question is, how did 5 get you 20? What was the balancing factor? And McKinsey has a similar data point, which says that historically, 60% of the returns came from leverage and multiple, globally. Globally. I think India does a poor job of explaining this and marketing the country. So value creation, you assume, is done massively in the West. I think Bain globally has done a fantastic job. I'm talking more about the overall thing. But it's essentially been leverage. And even when we compare to the public markets, and now the global funds are lagging the public markets, but if you normalize for leverage, they've actually lagged the public markets. In India, from a low base, the last 10 years, we've seen value creation meaningfully pick up. We assume roughly 2% IRR comes from value creation for us. And on an overall basis, if you look at the disaggregation of returns, leverage hardly plays a role in India, right? So the tailwinds that have become headwinds in the West are not affecting us at all.
But also the leverage has had a lot of tailwinds globally with zero interest rates or almost close to zero interest rates for the last 10 years.
It's incredible. 15. You've got availability of debt, you've got low interest rates, you've got improved margins as a result of that, you've got buybacks. All of that has allowed you to deliver with 3 to 5% top line growth, 25% IRRs. Right?
Whereas now going in the Western world, that's going to be a headwind.
Absolutely.
Amit?
Yeah, let me add to Kunal's point. Look, data for all of us is public. If you look at the last 4 Bain funds, our returns have generally been in the 20 to 35% gross dollar IRR range. And if you start disaggregating, how and why we make money, It is basically because of what Kunal said. So our most profitable market, Japan, is a bad macro.
Yeah.
And therefore, this obsession that we have that only good macro gives good returns in private equity doesn't hold true. It may hold true in public markets, but it doesn't hold true in private equity. In private equity, you can do a lot of other things to drive great returns. And for us, Japan is a great example of that. And the number one lever that you need to pull Leverage. There is actually operational performance improvement. And I completely agree with Kunal. I think the next 10 years, the differentiation will be about that. A very large part of our team is essentially operators who sit within them, many old colleagues of Manish, who essentially work with management teams to deliver either margin improvement or sales improvement or bringing in high quality people into companies. And I think that, in my view, is the future.
Yeah. Manish?
I'll get this back to India. It's actually a bit of what both Kunal and Amit said. If you go back the last 2 decades, approximately in 05 to 15 as the first, and then 15 to 25 as the other, we're much younger than Kunal, but our first fund, which had a 37% dollar IRR, if you break that apart, it's at least 50% multiple expansion, 50% EBITDA growth, almost zero debt. We don't know how to take debt and leverage. I would say if a fund 2 and 3 and fund 4 is too earlier, or 15 to 25, it'll be 80-20.
Interesting.
But I think if you are earning your 220 as a fiduciary, the constant for you has to be the focus on EBITDA growth.
EBITDA growth.
Multiples may, in fact, today for the first time, we're seeing in our IC decks, we're forcing people to put multiple compressions, which was actually unheard of for most of the team, given you've grown up in the the 2005 to the 2015 era. So I think going forward, who the hell knows? I never want to say the next 10 years, but I'd say if a private equity firm is not earning its keep and depending purely on multiple expansion, you're dead in the water today because it's also a much more competitive environment.
It is.
You can no longer, one is multiple is EBITDA growth. The other was entry multiples in the first, when I was at Temasek, there was no other play in town at 2003 or 4, right? So today, there is, if I underbid on something, Kunal's team will definitely have
it's competition,
right?
absolutely.
Or Amit's would. So essentially, the bar's really gone up in terms of what you can do and your underwriting process. So for us today to do a deal which could have been done only with pure investing teams 20 years ago, we won't dare to do it without our operating partners.
The same
guys that Amit talked about, right? But and we can talk more about that later.
And I think it's interesting that you're asking people to have compressed multiples. But can I ask, so private equity is, from an Indian corporate perspective, relatively new, right, compared to the global world. For all of you to add value creation and operational teams, has the founder mindset changed enough are the next generation of businesses interested in doing the business, or they are all opening family offices, which is at least globally a trend? If it is true, it's good for you because you get more professional CEOs and run. Would love to hear a little bit about how much of the founders are willing to let you come in and kind of, redecorate what is their home.
Sure.
Amit?
Maybe I'll kick it off.
Yeah, please, Amit.
It'd be great to get their perspective. So I think the two mega trends I see now, which are very different from when I started, I'm the bald guy on the panel, is that now buyouts represent a very large percentage of the market. And that's essentially because you're seeing a lot of people willing to trade, which was unheard of, especially if I go back to my days as a banker in the 90s, or when I started the Bain platform here in 2008. And I think that's basically because the next gen, in many cases, wants to run the family office or start restaurants or buy art or whatever it is. And that's absolutely fine. That might actually be the best way for the economy to, to take value to the next level. So I think that, I see that trend continuing going forward. And that's, I think, healthy in some ways. It's healthy, especially for our business, but it's also healthy for the economy. I think the second is that there are a lot of first-generation entrepreneurs now, thanks to this big spurt in entrepreneurship that happened in the last 15, 20 years. I think they think differently about engaging private equity than a lot of the traditional families did. they are more receptive, amenable. They're clear, of course, which areas they want you to operate in and what the terms of engagement should be. But I think that is different as well. So I think those two things bode very well, for the direction of the business that all of us do, and actually makes it easier to drive value creation. There's still segments of the market where people say they want capital, but that they want dumb capital, and it becomes,
of course,
therefore, they're better off going to public markets or, getting folks who just want to go in for the ride. I think at least for many of us, I think we stay out of those pools.
So before Kunal and Manish, if you add, can I ask you to add one more thing? Did you go and pitch to founders that we are Indian LPs versus Amit GPs? Does that is that part of your pitch? And do founders react to that, please?
So let me answer that first.
Please.
He has more of an accent than I do.
True.
Because of that statement, I was not going to say this, but since we've gone down that
path,
no, the one serious thing we do talk about is the fact that we're global, that we have a global outlook. We have a partnership with a firm called Clayton, Dubilier & Rice, probably has the most advanced operating partner model. But the fact that firms like ours and Chris are local, decision-making is far more quicker, and we don't run around in circles like Amit's teams might. But the reality is we can, and I think the Indian promoter really appreciates that the decision makers are in the room. There's no IC panel in Hong Kong, Singapore, and a second one in the US, right? So, and I've seen actually people make decks for the local IC, for the Asia IC, and we share that. Obviously, we talk about that. But to your question, I really think there are three types of promoters, right? Amit covered them well. There's the guys who actually don't want value addition. That becomes a minority deal. That's what happened in India. That's what we were known for. Historically, that was the only game in town. So we all did lots of those in the time around the financial crisis up to 2015 because we didn't know otherwise. And we didn't have the skill set.
No opportunities,
So in those set, multiple players, zero value addition, probably not a lot of value add, not mutual lack of respect. And your exit was also based on how generous the promoter wanted to be.
Fair.
Then you have a second and third type. The second one is guys, and there's one in the room, Sid Cage was around, they want to grow, they see the potential, they really believe the skill set that we add and the capital we bring in that order will help them grow a lot faster than they would otherwise. So they would sell a smaller stub today, let's say 20, 30 or 40%, grow with you, and then maybe exit 5 years later. And there's a classic example of Parkinson's Packaging, he's in the room somewhere, where Kunal started off, we took over, and we sold to Warburg. And the family ownership was partly sold 3 times. And they really, I think, smartly used a private equity firm at each stage of their evolution. And the final one, I think, are the ones you're referring to, which Harsh Goenka would love to talk about, which is they want to sell for a family. But that's, if I look into that, actually, the bigger thing there is, and all being so close to many families, the stigma which was there with selling to the businesses is no longer there, or far lesser. So the level of deals that we're seeing which are controlled are significantly higher. But for doing that appropriately, the biggest alignment you need is, I would still prefer, even if we do a majority, to have the family remain. In whatever role that because they know where the skeletons are, where the growth engines might be. But really add on the boosters with the sort of operating partners we bring to the table. Right? We have someone like a Nitin Paranjpe at Consumer. When we buy out an ice cream company, the promoter, it's called Dairy Day, we work with the promoter, but he's now down to 20%. And our operating partners really drive the EBITDA growth. And most important, the family believes we can deliver that with these guys. Otherwise, it's a no-go.
Kunal?
So, one slight clarification. We do have a large local team, but we're a bit of a hybrid. So, for decision-making, it still ends up happening in Mauritius, overseas. But I'll just take up, I think Amit and Manish have covered most of the points. But I'll answer a little bit of why and how. Right? So, because we have, over our 27 years, ChrysCapital has actually sometimes invested across the same company, multiple funds across the same. So we've seen our behavior, their behavior 20 years ago, our behavior, their behavior last 5 years. And I think there are a couple of catalysts that is driving this. One is growth is slowing down.
Yeah.
The 25% growth that was a given 20 years ago is more like 15 today, and if you're smart, you can get 20 plus, right? Two is certain success stories where professional CEOs have actually made a lot of money, has emboldened a lot of others to say, you know what, I could build my nest egg here as well. So we are inundated by inbounds of folks saying, we'd love to play a CXO role, we'd love to see if there's a CEO potential available. Third is the market is deepening on the exit side as well, right? And therefore, control exits, even if you want to use the public markets, there have been examples of sell downs that have happened. Now, when you combine all of that, that's what's spurring entrepreneurs to say, you know what, it's okay to do that. And what we have done as a result is 7-8 years ago, we started building our value creation team as well. Had we tried that 20 years ago, the entrepreneur would have kicked us out because they're like, look, you're interfering.
They don't want it.
Today, they actively want it.
That's
and where we have found success is actually in minority as well as in control of.
And there is both opportunity to add value there. Amit, you were a little skeptical. Were you off the stigma point, or you agree with that the stigma is much less now?
No, I think the stigma point is completely changed. I remember when I was running DSP Merrill Lynch, it was impossible virtually. When we did the first major M&A deal in the cement sector, for example, oh my God, it was like, everyone said, wow, an asset is trading. But even then, getting the next set of folks to get up and say, we're going to do this, it took a long time for cement consolidation to happen. Today, I think all that has completely changed. So the stigma point is a very important. People react to what peers, value and what they say, and that societal behavior is very, very important.
The one thing I'll add, Achintya, not on the GP side, even you had this assumption, even if it's subliminal, that more control means better returns, right? I've actually done this analysis where if x-axis shows the amount of equity ownership in a portfolio company, and you can have two y-axes. One is the amount of time you spend in the portfolio company. Second, your returns. You assume it's an upward sloping curve. As equity increases, more time, more returns. At least our data points of our 34 companies we've invested in today, it's a scatter diagram. Now, as an ex-McKinsey guy, I can take one data point and put any story I want to, but in reality, what I'm saying is our minority investments have often outperformed our control ones. And very often, our largest equity positions don't need as much time. Manyavar, for example, we had a less than 10% stake. But we had our main guy who does consumer spend 2 days a week there, which is...
And is this, Manish, the best of both worlds where you're getting operational value, but you're retaining the founder's vision and the founder's passion and all the... Is that what's creating this scatter chart?
No, I think the situation... To me, it all comes down to people. So to the level that you can bulk up the mid-sized company like a Manyavar, listen, Ravi Modi will always know the business better than any of us, right? And even better than operating partners. But what he couldn't do sitting in Calcutta, and I'm sharing, I'm sure he'll be fine with it, is attract the talent. Now, when I think having someone like us be there goes up a little bit, but if you see the source of talent, historically it was the McKinseys and the Citibanks and the Unilevers, right? So if you have 2 or 3 guys who's ex-McKinsey and Unilever and you call up a candidate, it's a game changer. So if you can do that quickly and bulk up the team,
makes sense.
And work closely, then your own involvement decreases substantially.
And just to add to that, I think what we have seen is, Manish mentioned COVID. So actually the engagement with the portfolio went up dramatically in COVID. We were always available, but the need wasn't as desperate. And post-COVID, that has continued, where now when you are engaging with an entrepreneur, you can always tell them, look, we've done 100 deals, talk to other peers in the space, see what it's like.
The track record is there.
And they become the ambassadors.
And the word of mouth, right? And the virtuous cycle of more founders, more money, more success. So maybe switching gears a little bit, what we're really talking about is that the whole private capital, private equity market in India is maturing. And I think all of you are now deploying multiple strategies. Maybe, Manish, I would love to start with you saying, how do you think about private and public in one strategy? I think, Chris, you have the same. And Amit, maybe if you can later talk a little bit about the distressed fund with Pyramid, just to say, is that a reflection of market realities? Is that a reflection of growth slowing down, Kunal, that you referred to, or just a more mature opportunity set? Manish?
Listen, for me, it's relatively simple. And I think the answers depends on each of us and our respective partnerships. But I would say for us, and there's no right or wrong answer, but the question in my mind is globally, would I want to be a KKR or a Blackstone or a CDNR or a Madison Dearborn, right? So do I want to be focused and grow? I don't want to say the large ones are only asset gatherers, but the moment you go multi-asset and you go public, I mean, I got the shock of my life when I saw GA buy an infrastructure company, right? That's not the tech investing that you saw. Again, it could be the right answer for them, but that's not what we're going to say. So we've actually written in our constitution, we will never go public.
You've written that?
We've written that, never go public. And if you were to ever raise money from a third party, it would be for a primary injection if we need the capital, which we don't think, but never a secondary to enrich. So I really believe this gets into morality and all that. But if you truly want to institutionalize the firm for the next generation, you cannot be monetizing it as the founding partners, number one. Number two, I do believe if we were to go to other strategies than we have on the public side, it's only when there are adjacencies. So our public market side is actually, India has 7,000 listed companies. I mean, we have more than the US. Most of these companies don't deserve, I mean, they shouldn't be public. Right? So if we've just spent 6 months looking at a deal which we lose to either Bain or ChrysCapital, we feel like shit. But this way we can at least take the learnings of that industry and say, who are the three guys who maybe, from a fundamental analysis perspective. So that to me is one. And the second, I'm not saying we'll never get into something else like credit, but if we were to, the core team cannot be distracted. It has to be another team. And it'll be then sort of our Chhatra Chaya that we would sponsor somebody else with a strongly independent management. But then the question comes, why would they want to come to us if they can do it? So that is the
But it is related is what you're saying. It's not completely standalone. Kunal?
So just adding to what Manish said, if you think about the public markets, the US has more funds than companies. Okay? The level of efficiency in the system, if you're trading in the US, most likely you're trading against a professional.
100%.
India is not that. So the ability to generate alpha is very high. Now this may sound odd today given market performance, S&P 500, all of that. But if you take a longer term lens, and we did this analysis, where you take a 20-25-year lens and take rolling returns. So starting and endpoints don't matter. Take a meaningfully long-term 7-year view. The US has done extremely well, but India has actually done well. And so that was the reason when ChrysCapital said we will have a second strategy on the public side. Those were the reasons we said it makes sense. There's inefficiency, there's a right to win, and the market growth potential is massive.
But it sounds like, Kunal, your strategy is a little bit more independent team, completely independent.
We have an independent team, just like he has said, and there is knowledge sharing, of course.
Knowledge sharing, got it.
But the ability to outperform with the right strategy, there is a lot of learnings you can take on high return on capital business.
And can your public teams buy an IPO of your private asset team?
So we, for now, have said no. No. We've kept it. We said, look, there are thousands of companies. It's okay.
Why focus on that?
And the public team is not happy about that because some of them have done extremely well. But I think there's a long leg of growth there as well. And so, I mean, when you pass it on to Amit, he'll talk about even multiple strategies. There's another angle to it also. As capital also in India is moving away from just physical to financial and within financial from FDs to equities, there's also a shift happening to alternatives. And, ChrysCapital hopes to tap into that as well and then offer additional solutions to those family offices and others.
And the alts. Amit, maybe a little bit on the distress strategy that you have started?
Yeah, so maybe I'll take it
please
from a couple of levels higher than that. I think we are probably the last person standing on listing amongst the large funds globally, amongst I think the top 6-7 folks on AUM. I think we're the only unlisted firm left, and I think we are quite clear. We want to basically be a private firm. We see a lot of value in that, and we've not had any paucity of opportunity by remaining private.
No.
So I agree. I think, in fact, if you go private, if you go public, then different incentives come in.
Of course.
You do get pushed to become...
The AUM race really starts.
And it's been great because I think by not getting into that race, we've actually been able to grow in a very deliberate manner, which is more profit and value oriented than AUM oriented. We've actually grown into a multi-strat firm mainly because, we always, when we operate in markets, we sense that there are opportunities. And if you do a good job with talent, then that talent is normally the best positioned to go after it. And so a lot of our expansion has been driven by people who have come out of the private equity team and have opened up new strategies for us. Kunal, Sanjay and I have spoken about this in the past as in context of ChrysCap's long-term plans. I do believe that every large Indian firm should think about being multi-strat. Because personally, I feel a economy of India's size, there will be a lot of opportunities which will present themselves to the large Indian firms, especially the folks who have great leadership like what Kedaara and ChrysCap have. And that should be exploited. You can be deliberate as to what you start when. You need to create the right governance structure. But I think rather than just wait for the global firms to make most of those opportunities, I think the Indian firms should dive in and make the most of that. We are highly underserved when it comes to a lot of niche strategies. We saw that opportunity when it came to distressed many years ago. It was not very efficient for us to do it directly, so we did it by way of a joint venture. Worked out very well. Our first fund with the Piramal's India RF has returned a 23% gross fund, largely capital protected. Worked out as a great strategy. We are just about to close our second fund, just waiting for the last round of investors to circle up. And that's a good example of there being market niches that, you can exploit either directly or indirectly. And we today have a separate floor in our building, which is dedicated to special situations and real estate, etc. So I believe that is the way that many firms, whether Indian or global, should grow in India because, just the way we thought earlier about private equity narrowly as just growth capital, and now it's like the whole spectrum. I think it's going to go beyond just equity and it's going to be multi-strat.
And I guess real estate and credit will happen at some point in the life cycle as well.
Absolutely.
Maybe one last topic before we close is India has continued to be a largely consumption economy, largely services economy. Are you seeing, and we had a session earlier of Makers of India where there were 3 great manufacturing entrepreneurs. Are you seeing enough of a pipeline from an investment perspective? What kind of confidence do you have of India actually becoming, the Make in India becoming a real success? Maybe Manish, with you, I'll start.
I think if the Make in India is talking about product development and R&D, it's phenomenal. I mean, I think the reason we're also excited in India is the quality of the entrepreneur class. I'm going to be a little off mark on this one, but if you look at it as purely manufacturing opportunities, which is I think where your question is going towards, the opportunity has always been there. If you look at our automotive guys and auto components, is globally competitive. Manufacturing, we probably look at pharmaceuticals is by far. The issue recently, which is irritating me, is the focus on manufacturing has been because of this whole AI thing. And so if it's the one thing which won't be affected by AI, so let's go into manufacturing, that's a safe harbor. To me, that's thinking is otherwise, it has always been a strength, and I think the government's policies
are helping
focus, and I think especially as different states, it started off with Naidu in the turn of the century, but every state is now going out and attracting companies to put manufacturing, to do job employment. That's not our responsibility, but the addition of those freebies really
will help, of course. Kunal, do you see the same pipeline?
I think manufacturing is a lost opportunity for India that in the last 5 years we are focusing on as a country. And I think it's very important with job creation.
So what, you said lost opportunity, Kunal, sorry to interrupt. What needs to change for it not to be a lost opportunity?
So I'm saying if you go back 20 years, and say what was manufacturing as a percent of GDP and where could it go, we've lost a lot of time.
Correct.
Right?
Correct.
In the last 5 years, I think the government's also put real emphasis on this. And I think there's enough low-hanging fruit to really kickstart it. So everybody talks about Apple and how many of their iPhones are made here, right? That ecosystem, the supply chain can actually lead a lot more tier 1 suppliers and others to build out. So for ChrysCapital in Fund 10, actually 2 of our 4 investments are in the manufacturing and industrial space. One is in an EMS space. The other one's playing a little bit on the data center capex boom. I think India needs this. And I hope that this time around we actually capture it as a country.
Amit?
You know, this is a much longer conversation. I agree with Kunal's framing. I think India is, unfortunately, we have lost a lot of opportunity, but I also look at it that if we get a few things right, this can be an incredible place for investing and for living and everything. Manufacturing, just what we've achieved in the last 5 years tells us of what the potential is.
100%.
It's just one product. Just imagine if we start extending that to different, if we start going deeper and we start going broader. Semiconductors, we're just starting. How much PLI have we disbursed? You know, just $1 billion or a couple of billions, right? So we have the balance sheet to do a lot more, and it can be truly transformative. The same thing can happen in a lot of other areas. R&D, we spend very little. If we start spending money, we can truly be an innovation powerhouse. And in my mind, I think the other big lost opportunity, which hopefully at some point of time we will start setting right, and largely is because of the Gulf crisis at this point of time. Look, we keep forgetting that 40%, 45% of our country is agrarian. Right? And essentially most of those people, 95% of those people live on subsidy. Essentially, they make, you know, way below the per capita GDP. If we can figure ways in which these people are lifted materially, then they will really become consumers. You can't become a Viksit Bharat if your farmer is not Viksit, right? Now, you know, the Gulf crisis comes in because we have a great biofuels opportunity. If we basically start, Maruti just announced that they're going to come up with their first flex fuel vehicle, right? If we start producing biofuels in mass numbers, we'll actually start transforming the life of farmers. So I think this whole pulling in a few 100 million people into consumers could truly be transformative at the bottom of the pyramid. I mean, that's where Bajaj will then sell, you know, be growing at 25% and not, you know, 10% plus for a decade.
But look, I agree. And on ending note, in the last 2-3 days itself, like I've met one company who was in Vapi, and they're manufacturing high-end medical equipment sold globally. And you know,
it's a great story.
This is a fantastic story, right? I mean, which you wouldn't have heard 10 years ago. And I actually love the fact that it's in Vapi and not in Bombay. You know, and I think the more such stories come, this is the future of India, where there is so much potential in the tier 2 cities which are being developed. But anyway, on that positive note, gentlemen, thank you.
Thank you.
Thanks for joining us. Thanks for all the capital, and thanks for the growth. Thanks, everyone.
Thank you.
Thank you.
Manish, thank you so much.
Good job.
Thank you, panelists, for your cutting-edge perspectives. Ladies and gentlemen, I'm sure you all are very excited to hear from Ariman Vikram Birla and Sunil Gavaskar in our next session, which promptly starts at 1 p.m. Till then, we break for lunch. Please make your way to the adjoining ballroom for the lunch, and please feel free to bring your meals back as you enjoy the session alongside. We look forward to welcoming you back at sharp 1 p.m. Thank you.